My next guest actually has her doubts about the Fed hiking rates 4 times this year. She thinks it'll be fewer and says the best approach right now to investing is to pick so-called Goldilocks stocks. Joining me now is Nancy Pryl, the co-CEO and senior portfolio manager at Essex Investment Management. Nancy, welcome, and tell me how you expect this all to play out.
So we are cautiously optimistic that the current rate expectations for 4 or possibly more rate hikes, plus quantitative tightening, and some chatter about a potentially surprise hike in January, 50 basis point hike, and the first one in March, are based on backwards looking data. It's based on the belief that the 7% inflation rate is where we are and that it could possibly even go higher from there. Now, some parts of what we've seen in inflationary are going to be sticky, particularly wage increases, rent increases, et cetera. But we think that what the market may be missing and what we think the Fed will be focused on are signs coming in the future of a decline in some of the raw material and other cost pressures that we've been seeing. Particularly, we could point to the easing of the supply chain imbalances, as well as some softening of home price increases.
In other words, you think that the inflationary pressures will resolve themselves, so it won't be that the market has to sell off deeply. It won't be that the Fed has to throw in the towel on its plans. You just think that we won't have the inflation pressures but look at energy even today, right? Isn't that going to be a big source of upward pressure?
So we think that this will be a process over time. And we do think that over time, we will see that the rate of inflation is coming down. That doesn't mean we won't have inflation higher than we had before the pandemic. We fully expect that inflation will be 2.5% to 3%, and we fully expect 2+ rate increases or 2 rate increases plus quantitative tightening. But we think that the Fed will remain data dependent. And as the data comes in and shows a softening of the rate of increase of inflation, that will give them the room to let these first rate increases play out into the market, and that the market, which is rightly addressing the fact that we will have rates higher and that the Fed needs to get back to where they were pre the pandemic, that they won't have to go quite as sharply as the market is currently forecasting. And I'd remind our viewers that we saw a similar rate in the increase in the 10-year last year, which did not play out into the rate increases that the market expected.